Hi guys, thanks for tuning in to another episode of Nuggets News, or our monthly housing and economy update with our friend Martin, all the way over from London. You're an expat now, Martin, or are you still claiming you're Australian?
Well, I'm here on a project, so we'll see how long the project goes. I'm trying to deploy my surveys into the UK, and it's taking a bit longer than I expected. But certainly at the moment, I'm enjoying being back over here, catching up with old friends and family. Although the autumn is a bit cool now, and I'd forgotten how much all the leaves drop off the trees. It's amazing.
Oh, beautiful. There's some interesting slides about some of the household surveys, which we'll talk about when we get to them as well. But it was actually 27 in Tassie today, which feels like 37. So I think this is the first episode I've ever recorded in footy shorts, Martin.
Oh, well, it just happened occasionally in Tassie. But of course, the weather over in Australia is all over the place with the fires around Perth, north of Perth. Interestingly, in some of those areas where mortgage stress is very high, interestingly. But yeah, funny weather all over the place, really.
Okay, let's dive into this because there's plenty to talk about today and plenty going on as well. I want to show, I'll bring up that true inflation data as well because we're going to talk about some of that US and UK stuff as well. But first up here, you've got bond yields cooling off after they peaked back in October.
This is an amazing turnaround. So, when we did the last show, we were talking as across the US durations of bonds, 5% was showing up. And everyone was saying, well, how high will rates go? Well, it's completely turned. So we've now got bond yields significantly lower, and they're continuing to move at a much more steady pace. Now, of course, the question is why? Well, the Fed speak over the last month changed a little bit, but it's interesting that some are still saying they think rates may have to go higher to be able to crush inflation. But some of the economic data started to show signs that the US economy is slowing and therefore inflation might be coming back into more control. But of course, everyone's still saying higher for longer. So it's really interesting just how dramatically the bonds have changed. And the corollary of that is the stock markets on the next slide have actually raced to new highs. And it's interesting now that we're in the situation where some markets are, knocking on those all-time highs. In November, markets moved up dramatically. So the S&P up, 7, 8, 9 times, up 9%. So amazing, a big turnaround. So the question is this now overdone the other way? In other words, are markets now factoring in effectively the assumption that we'll have a very soft landing and inflation will be under control, and then the central bank, particularly in the US, will be able to cut rates? And the view I have now is the markets now are being focused on rate cuts. The Fed is still saying rate cuts not in the short term. We've got to keep rates higher for longer to be able to tackle inflation. And it's interesting that inflation is knocking around, the 4 point something. It's still not at the 2 point something, which of course is what the Fed is trying to do. So markets, I think, are now fooling themselves on the other side. So we've had one head fake around bonds. Now we have another head fake around the stocks. But interestingly, the other factor, if you go to the third slide, is that pretty much all of the boom in stocks is to do with the Magnificent Seven. In other words, those big tech stocks. And so if you look at the data here, you can see that basically, those have gone massively up, 71% higher. The remaining 493 companies in the S&P 500 were about 6% higher across the year, right? And so the S&P 500 up 19% across the year. So this is a very narrow-based story at the moment. And so the other question then, is it going to broaden out? Or are we going to see this continued bifurcation between the Magnificent Seven, which is all about AI, and the rest of the markets? And so those are some of the sort of the top-line questions which the markets are trying to wrestle with.
Yeah, a couple of things I'd add to that is when we saw this time last month when we were chatting, and those rates peak around 5%, some of the Aussie banks have sold huge tranches of reasonably good grade bonds because at the end of the day, people think, well, the government aren't going to let the banks fail, or the RBA isn't. So some of those bonds were yielding 7.5%, even 8.5%, and they've been snaffled up by investors. It's very, very juicy yield, and we've seen again banks making huge profits even in tough times. But as you mentioned, yeah, those tech stocks, and I think it's been interesting. A lot of the chat in the news about open AI and firing Sam up when they're getting him back and that kind of thing. I think that, yeah, companies like that are very hard to compete with because of all the data they own to produce the AI, that they can become multi-trillion-dollar companies and join those big seven, I think, in the coming years. But yeah, I still think broadly that because there's been so much money printed, we can see stocks and houses and things continue to go into a bubble, as even if they have to be sold, it's by the people that are struggling, and they're just going to be sold to the hands of the wealthy.
I think that's absolutely right. And of course, we've got massive amounts of liquidity around the place. And in fact, a lot of money flew back into the stock markets in recent times, having been in the bond markets previously. So we're seeing some switching around between asset classes. But you're right. We have so much liquidity, so much money printing that assets are potentially going to continue to bubble up unless we get this massive crisis. Now, it's interesting that the forward prognostication on future growth and the risk of deflation hasn't gone away completely. So there are some people talking about it, but the markets are ignoring it. So they're basically saying, whoopee, we're going to have a run up now, a Santa rally up to the end of the year. And the question, I think, for me is not so much what's going to happen in November and December, but the first quarter of next year. Because if earnings continue to perform well, then stocks can continue to rise. If earnings begin to weaken, and there are some forward signs now that perhaps in some sectors like retail, earnings will be lower. So it'll be interesting to see. But you're right, there's too much liquidity. And, Our global economy has been messed by central bank strategies since 2008 that we're still wrestling with.
Absolutely. Okay, moving on. So US inflation and a lot of these other countries have started to roll over, as we mentioned, same with bonds.
Yeah, but it is worth just mentioning that, of course, the US inflation is down. Of course, CPI, lower as it's been. The UK inflation was down on the various measures that they use, and even in the euro area, inflation is down. But interestingly, most of that is to do with base effects. So we had very high energy prices a year ago. They have now dropped out. Services inflation is still quite sticky, and services inflation, of course, is much more to do with wages. And it's interesting that Michelle Bullock today gave a speech, and in it she said, well, hairdressers, they're having to charge more because they're having to pay higher wages. So there's a significant concern that, in fact, there are elements to the inflationary story that are actually still bubbling higher. And interestingly, of course, in Australia, we didn't get a drop in inflation. In fact, our inflation went up. And as a result of that, the Reserve Bank lifted rates again. And Michelle Bullock, the new governor, is now saying, well, we may have to lift rates even more. And now, if you make some comparisons then between where Australia is and where the other major economies are, it's very interesting. This actually came out the other day, and it showed that Australia is in pole position with headline inflation at 5.4%. And at 5.2% core inflation, we're just behind the UK, but we're right up at the top. So I think that the story of inflation in Australia now is behaving slower than in some other countries. But interestingly, about half of the inflation in Australia is directly related to policies that Australia has executed. So, for example, we've got very high inflation because of the gas policy. We've got very high rental costs and housing costs because of the migration policy. Got massive amounts of migration. So with that, and with services, inflation still very high in Australia because of the fact that wages are rising in the services sector. The chances are we're going to see inflation in Australia now hanging around and going out for longer. And in fact, the latest RBA projection on the next slide shows that they're now saying, well, we think it'll probably come back down to around 2 to 3%, but not until 2025. But inflation will be higher for longer. And that implies, of course, that interest rates are going to be higher for longer. And again, Michelle Bullock today was highlighting the fact that there was more work to do. So I think Australia, unfortunately, is in the situation now. You could argue 2 points. I think the first is that they didn't lift rates quickly enough, early enough. And of course, we had rates very low level. So we have RBA policy mistakes again. But the second point is, a lot of the inflationary pressures now, it's not to do with the correction of supply chains. It's to do with local policies in Australia, which means that potentially, unless the policies from the government change, and migration will be one of those policies, we're going to see inflation in Australia hanging around, which means interest rates will be much higher for much longer, and that's very bad news.
Yeah, so we've probably in previous episodes spoken about immigration directly and how that's going to put upwards pressure on house prices because we can't build enough houses, but we haven't spoken about those things maybe indirectly. You mentioned things like hairdressers. Well, if there's 500,000 more people, they've all got to get their hair cut. They've all got to buy food and do all those other goods and services that people take up. So that causes some of that stickier inflation. And the other thing is the state governments on infrastructure. So state government debt has now overtaken annual federal government debt spending. So spending on a lot of these projects and that type of thing, which takes away some of those builders that might have been building the houses, the materials that we have. That's that cycle that's more vicious maybe in Australia than some of these other countries because of immigration, because of our love of the housing market.
Yeah, and of course there are two observations there. The first is that the Treasury and the government welcome high migration. Why? Because at the top line, it helps to grow the GDP. They get more tax. And of course, as inflation rises, people are having to pay a lot more for the same things that they bought, which means they're paying more in the way of GST. Also, of course, they've frozen the various tax bands. So effectively, more people are now paying more tax. So inflation is working for the government in terms of helping their finances, but it's not helping individuals. And I come back to this point. A lot of the inflationary pressures in Australia are not now the result of the COVID problem or the supply chain disruption. It's a set of policy decisions that governments, this one and the previous government, have taken. And unless they make changes to those policies, inflation is going to stay higher for longer, which is going to put a hell of a lot more pressure on a lot more people. And, you know, the simple answer is dial back migration, because if you do that, then some of these things can get sorted. If you don't, then effectively it's going to continue to be a problem. And, you know, we've had, 500,000 plus new people coming in the last year or so. The expectation is that those numbers are going to stay high. A lot of those people go into the rental sector, which means they're putting huge pressure on the rents. So that's why rentals are going up very significantly. And of course, a lot of people then move to buy. And interestingly, in my surveys, it's the first generation migrants who have the highest rental stress. So the people have come into the country, tried to find somewhere to live, and they're now struggling to pay the rent. So I mean, it's a big mess, but it's a set of problems which have been created locally.
Yeah, and a catch-22, because if you keep that immigration high, you kind of have to spend on infrastructure.
Yep.
Okay, so moving on, household confidence is still pretty weak.
Yeah, and not surprising. So given all that we've said, and given the fact that in real terms incomes are going backwards, as we'll see in a second, households are really up against it. And certainly we've got a proportion of households that are still doing very well. They've got perhaps more savings and they're getting bigger returns. As you said, you can get 6, 7, maybe even 8% on some investments now. But there's a lot of people who are not, and therefore overall confidence is very low. And we're in levels now of confidence that, well, we hadn't seen previously, other than COVID. And there's not any sense at the moment of that changing anytime soon. So that's a problem. And interestingly, that's in the context of the next slide, which is that unemployment is still relatively low. And the latest numbers really showed that things were actually remarkable. Although Warren Hogan, who I quite like as an economist who's got a slightly different view, and he said that the RBA released the updated economic forecasts, which showed employment growth of 2.5%. Just later, basically they're saying, hang on a moment, it's all over the place. So he's basically suggesting that the RBA hasn't got its modelling right, and that may indeed require higher interest rates as a result. But then the question is, are those numbers right? And on the next slide, well, maybe not, because there's a big question as to whether the current ABS methodology is capturing that migration we were speaking about. And it's interesting that if you look at the comparisons as I showed on the previous slide, between what the Roy Morgan survey said and the ABS, there's a big diversification. And in the same on this slide with the unemployment and job applications. So maybe the problem is that the ABS statistics are not adequately capturing the migration. It's interesting, I posted here a couple of little segments from the most recent ABS on this, and they're making the point that they're going to start inserting the census data from 2021 into their modeling. So hang on a moment, we're taking a baseline of 2021, so that's before the 500,000 people have come into the country. So my argument is maybe the problem is not that unemployment is so low, maybe the problem is that the ABS statistics are just way off, and therefore the Roy Morgan, which is showing a higher level of unemployment, is a better analogue as to what's going on. So this is a really important point, because with such big migration coming in so quickly, I think the stats are just messed.
Yeah, the other thing I'd add to that is the last time we saw a big uptick in unemployment years ago, the gig economy, the Ubers and that, where you could pick up a bit of work, and things that now might fall into underemployment, which doesn't get counted in unemployment. I just think the structure of the economy's changed a lot in recent years with a lot of these apps and that type of thing.
No, you're dead right. And of course, the other thing is a lot of people now are getting multiple jobs. So they're working a main job, and then they're doing 2 or 3 small jobs, part-time jobs, gigs, or whatever. And so what we're seeing is that the hours worked, well, it ticked up a little bit, but not as much. So maybe the situation now is that all those people who had flexibility to basically work more to earn more have already got that. So, they can't go on doing more. So essentially, it's going to put more pressure. And the reason that people are having to do that is because real incomes are continuing to go backwards, which is the next slide. So if you look at this from an ABS perspective over the last few years, you can see that across the country, real disposable income per capita, so that's inflation adjusted, has dropped very significantly. And in fact, there was a chart that came out recently that showed, compared with other countries, Australia's leading the charge with a 5.1% annual drop in real gross disposable income per capita. So we are leading the charge, ahead of Norway and Sweden, and there are other countries that are actually positive. The UK is positive by 2.2%, UK positive, Australia negative, down 5.1%. So households are going backwards. The other point I'd make, I mentioned earlier on, the tax bans and the way that the tax bans aren't moving sufficiently to reflect inflation means that people are paying a lot more tax than they were. So more people are being pulled into the tax machine, and more people are having to pay more tax. So the point is that real incomes are dropping. You're paying more tax. Government will love you for that, of course, but it doesn't actually help. So I would argue that we've got a real crisis now in Australia, with the cost of living rising dramatically, but effectively wages, income not.
Yeah, just for people at home that aren't familiar with tax brackets, what Martin's talking about is if you're on 119 grand a year and you get that pay rise up to 120, you might be celebrating. But if it makes you fall into the next highest tax bracket where you pay a bigger chunk as a percent of tax, then you're no better off. And as we're going through an inflationary time and more people are getting those, they may be slow and small increases, but it's pushing them up into those next tax brackets.
Yeah, and in fact, in the UK, they've just had a mini budget in the UK. And because of tax bracket creep, they're now saying that they'll get an extra £50 billion in the forward period, simply because of tax creep. What they're able to do then is to actually give you a small amount of that back, which is what they announced. But in fact, net, the government is taking more and more. So they've got a higher tax take than after the Second World War in the UK. And I suspect the tax take in Australia is going the same way. So we're going to see more and more of incomes sucked into the tax system, which means that government will have more money, but of course it's at the expense of ordinary households.
Yeah, and that gets in that philosophical question of, well, if governments really get to spend money for free and they're taking it away from all these households that are struggling, and in somewhere like Australia where we've had the commodities and all that helping our budget and actually getting into surplus, what is the point of the way the financial system is working if someone that can spend money ultimately for free and taking it away from all the people and putting the population under more stress. Is that the best way to do things?
No, that's a very, very good point. And, the question is, who is the economy working for at the moment? My argument is it's not working for ordinary Australians and ordinary businesses. It's working for the big end of town. In a sense, it's working for the politicians who still manage to, bring those big salaries and the superannuation for the rest of their lives, etc. So, to what extent is the political agenda malaligned with ordinary people? I think it is. I think I have to say that the current government, I think, is doing a lot of stuff which is not helping, and I actually don't think that many politicians really get how serious this is for ordinary working people and ordinary small businesses. Again, in my surveys, I'm seeing this left, right, and centre. More people are under huge pressures, and you can do some things in the short term, but if the overall policy settings are actually not set right, then effectively the economy doesn't benefit you, and you become a cog in the machine. You have to work harder, work longer, pay more tax, but who are the winners? Not ordinary people.
Yeah, and I guess just off on a little bit of a tangent, we've seen in Argentina, the recent election, we get some that the mainstream would call, radical. But if that shows the extremes of the economy and monetary policy, where they've had hyperinflation for so many years. We saw a country like El Salvador go, hey, let's adopt Bitcoin. It can't be worse than our local currency. Maybe Argentina do the same in the future, whatever it is, whether or not that's the right answer. But these types of things, when people do decide to revolt, can bring about radical changes with politicians being so out of touch and not representing the people.
Yeah, and it's interesting that Argentina is suggesting they don't need a central bank anymore. As a big question, are central banks part of the solution, or actually are they part of the problem? And I would argue that the combination of bad central bank policy, bad treasury policy, bad government policy that we've had in Australia explains how we've got to where we've got to. It didn't have to be like this. There were decisions that could have been taken differently, but they weren't. But of course, we're basically just being caught in this cross stream of significant financial uncertainty. And all the surveys that I'm seeing, whether it's from the Salvation Army or from some of the financial counsellors, are saying they're getting more and more people who are just, at the end of their tether. What are they going to do? There's no way out. And it's, again, I come back to this point. This isn't just an accident. This is deliberate policy that's been run for a good number of years, and it's not benefiting ordinary Australians.
Okay, so wages growth lagging in Australia.
Yeah, and just to underscore that, we've had some wages growth, but we're still growing at a lower rate, despite the fact inflation's higher. In other countries, wages growth has been quite a lot higher, and in fact, it's positive in the UK now for the first time, which is interesting. So again, Australia a long way behind, and no surprise then if you go on to the next slide, that means that household spending is tanking. This is from the recent RBA report. Whether you've got a mortgage, whether you have no mortgage, and pretty much every income quintile, in other words, different segments of the population, people are spending more on things they have to buy, and they're spending less on things that they would like to buy, the discretionary items. Though it's not equally spread, of course. Those without a mortgage, those with significantly higher incomes are doing somewhat better. But this is not good for the overall economy, because more than half of the economy is actually household spending. So if household spending tightens, that puts downward pressure on growth, on our momentum in the economy. And that's another problem. And again, it's because people don't have the money anymore. If you've got a mortgage, you don't have a mortgage, you're paying more for your on interest. If you've got a mortgage, or if you've got rent, you're paying more on rent. So it is much more difficult now than it was to navigate this. No surprise then that we're going to see spending tanking. Question is, what will happen over Christmas? Will people say, oh, hang it, I'll just have a good Christmas and think about it in the new year? Probably. A lot of that will go on to short-term debt. So credit card debt's rising. Buy now, pay later is also still quite strong. That could be an issue, which people will say, well, we'll sort it out after Christmas. We're going to have a good Christmas anyway. So we'll see whether that plays out or not.
Yeah. All right. So this is a good example, and I might just bring up that Trueflation data I was talking about, where the way that they measure inflation in the UK, where are we here? UK inflation rate. So they had it peaking at around 22% in January this year, and it's come down all the way to around 4 or 5% in the way that they measure it. And when we look at this chart, that's about the gap, 25% between the value and the volume of things that people are buying in the UK.
Yeah, and what's interesting about the way that the UK reports it, it's much clearer than the Australian method for reporting all of this stuff. So it really shows that because of the fact that the value has gone up, because the price has gone up. So what it basically is saying, you are having to spend more than you spent last year just to buy the same things. Now, you might buy cheaper things, but if you look at the total volume of things that you bought, it's not gone up at all. In fact, it's going backwards. And we're seeing exactly the same in Australia too, and another example in other Western countries too. So this is inflation in action. Inflation is a tax, effectively. It's a tax on everybody who is spending, because you're spending more to buy less. And that's a real problem. Like I said, with half of the economy driven by what consumers do, if consumers are actually, in terms of volume, spending less, that's going to have a downward pressure. And by the way, in Australia, of course, we've had very strong migration, so you would expect to see retail growing a little bit more than the UK, but it's still somewhat similar in Australia too. It's just that the information is less easily presented.
For that website, if anyone wants to have a look, it's just trueflation.com. You go through the
it's worth looking at. It's really quite interesting the way that they do it, and it's much more accurate, I think, than the official numbers. Surprise, surprise.
Yeah. All right. So housing affordability.
Yeah, so this is interesting. So the CBA came out and said housing affordability is pretty much shot, right? And they actually showed the average and median, so that's the chart. But it's interesting, the way they calculated it was they took basically the average dwelling price and the assumption that the average household had 2 average household incomes. So you can see here that their assumption was that in Sydney, the average household income was $215,000 and the average dwelling price just over $1 million, right? If you take Hobart, they're saying the average household income in Hobart, $185,000, and the average price in Hobart, $655,000. Now, then they said, well, actually it's shot, affordability is a problem. But my argument is, yeah, but actually those household income assumptions, 2 dual income, incomes are actually not right. So I actually put at the bottom of that chart there, down on the bottom right, the average out of my survey. So this is average real income. This is gross income. And you can see here that in New South Wales, the average gross income is about $122,000, whereas they thought it was $215,000 for their modelling. So if you think housing affordability is shot, as CBA said, in real terms, it is absolutely shot.
Yeah, and I think there was another article floating around social media that grabbed the headlines. I'm not sure if that was using averages or medians as well, saying you now need an average of 300K to even get on the property ladder or whatever it was. So yeah, there's been a lot of those articles grabbing the headlines since this
absolutely yeah. And if you go to the next slide, not surprising, the household debt service ratio, this is basically driven from the Bank for International Settlements data, shows that the Australians have the highest debt service ratios in the world. Now it's the relativity that's important here, right? So if you look at what's happening in Canada, which is also has a very significantly broken housing market, Australia is just so much higher. And of course the 17% of income is understated because not everybody has a mortgage, so it's an artificial number. But relatively speaking, we're actually in Australia right at the top of the league. We've been there for some time, and you can see just how steep that rises, which means that people are going to have real issues going forward. And the corollary of that, if you go to the next slide, is that we've got a collapsing number of people who own their properties outright, and it's across the board. So more have a bigger mortgage for longer, and interestingly, even those aged 55 to 64, a greater proportion have mortgage as they go into retirement compared with what they used to. So if you look at that one, in 1995, about 70% of age groups would have been free of mortgage. They don't own it outright. Now it's closer to 40%. So we are mortgaged to the hilt. And that's a problem because, of course, the average mortgage is longer, the average mortgage is bigger, the average interest rate's a lot higher. So the banks are having a field day because, of course, they're going to get more interest for longer. But the bottom line is that many households are struggling now with these big mortgages. And again, this is a structural issue. This isn't just a happenstance. This is because of bad policy over the last 15 to 20 years.
Absolutely, and it all looks good on paper if you're on the property ladder, and you can borrow against your mortgage and that sort of thing. But it's just killing those that aren't, and renting and falling behind.
Yeah, absolutely. And the point I want to make is, if you go into retirement still having a mortgage, right, then you've got a choice. Assuming you've got superannuation, you could pay off the mortgage by using some of the superannuation. But if you do that, then you're going to have a smaller pool to live on beyond that. Or if you have not enough superannuation, you then go back to on the government pension. So this is a situation where it's not going to help the overall government finances into the longer term, because effectively you're going to have more people on the pension, and people are going to be in old age much less well off than they thought they were because of this wretched mortgage still hanging around their necks. And of course the banks at the moment saying, well, if you've got a problem, we'll just extend the mortgage. That's fine, feel free. It's good for them. That just means you're paying more interest for longer. And I'm afraid that this debt machine, again, it goes back to this point that we made earlier on. The debt machine benefits the banks. It benefits the government. It doesn't benefit ordinary people.
Yeah, are we heading to a world where, people say you're going to own nothing and be happy and that type of thing? Well, does it become a generational thing where your parents struggle for their working lives to pay it off, and then they hand it down to the parents in title, but then they've got to roll over that mortgage, and you're just constantly paying the bank in perpetuity to not own something. Well,
you are effectively already seeing that. So, you have intergenerational mortgages, you have, much longer term mortgages. And also, of course, if you're a first-time buyer, you need help from the bank of mum and dad. So if you are fortunate to be in the situation where your parents have paid off their mortgage and they've got equity, they're now handing some equity down to help the next generation. So it creates much more inequality in society. It makes it much more difficult for many people to get into the property market in the first place because prices are so high relative to incomes. So whichever way you look at it, it's a bit of a mess.
Okay, second last slide. The number of sales at a loss in New Zealand.
Yeah, this was interesting. So, of course, New Zealand's been going through the same hiatus as Australia, with interest rates very low. Then they lifted rates. They dialed back investment property. They tried to encourage first-time buyers to buy. A lot of people bought a couple of years ago when rates were ultra low, and then, of course, rates went up again. And now what we're seeing is that, so we've got a lot of people who are actually deciding to sell their property at a loss. And the average sale at a loss is 2 years. So it's interesting that New Zealand is now, because of what's happening, they're seeing more people being forced to sell. Now, whether they're being forced to sell because they need to move, or whether they're being forced because they just literally can't afford to make the much higher repayments is an interesting question. But it does show you that there's a real issue under the surface. Now, interestingly, some data coming up from Australia is starting to show that in some areas we are now starting to see some sales at a loss. And whilst, of course, the headline news is that property prices are, in some cases, in some geographies, up to near record highs, it's not universally true, particularly if you've got a unit, by the way. And so what we're seeing now in Australia is the same thing. So we're starting to see more people making hard decisions about should they try and hold their property or should they sell it before prices perhaps ease. And by the way, with the listings now beginning to rise in some areas, and with the momentum that we're seeing in terms of international people coming in and wanting to buy, there's some interesting transactions going on. Quite a few of those transactions are from overseas migrants. And so again, local people are finding they're able to sell if they need to sell, but some as a loss. So it's just a little observation. It takes time to work out. It's going to take 2 or 3 years before we see how this all shakes through, but it's quite interesting.
Yeah, I guess the thing I've heard from a few of my real estate agents friends are that people are starting to sell that second, that second home now. The property's rebounded strongly, and they can do what we say and go, hey, you know what? If I'm about to retire, I can get 5, 6, 7%, or maybe they want to roll it into the stock market or whatever else, just have that cash in the bank. So yeah, we're starting to see it. Whether or not that's not that's at a loss, I'm not sure.
Yeah, absolutely.
Rounding out the SQM scenarios.
Yeah, it's interesting because Lou Christopher's published his annual projections and scenarios. It's quite interesting just looking at them. So he's basically saying, look, there are a number of different scenarios, but it's interesting how he's now calling out specifically the issue of population growth will impact house prices, which is, I think, a very important observation. It's one that I've been talking about for some time, and I include it on my modelling. But he's saying there are scenarios where you could see property prices slide a bit. There are also scenarios where you might see property prices not sliding and moving up in some areas. But it does look to me as though, the story of Sydney and potentially Melbourne is that there's actually, a bit of downside risk there. And of course, it depends on what happens to interest rates, and it depends on what happens to migration. But it's interesting now that in his scenarios, he is really, really now drilling into the impact of migration, which for me is probably the most significant influencing factor, and explains why it is that house prices are doing what they're doing at the moment.
Yeah, and I even think that other scenario we've spoken about, but just because there's been so much money printed, and you think about things, houses are being priced in Aussie dollars, which has lost its value if migrants are moving over from countries that had stronger currencies, or all those reasons. I really think that we can see a bubble in a lot of assets just sheerly from the amount of liquidity that's floating around there. Even though on the flip side of that, we might have the recession, unemployment might be ticking up, and none of that stuff matters proportionally to how much money is being printed because of what we saw the last few years.
Yeah, and you've made a really, really important point. Maybe the way to think about it is not so much it's about the inflation of prices, it's the devaluation of the dollar. So in other words, your purchasing power has been eroded dramatically thanks to government policy and central bank policy. And, if you are in that fortunate position of in the few percent who've got huge amounts of assets, huge amounts of capacity, you're doing really well at the moment. But for a lot of other people, the spending power is continuing to go backwards. Your incomes are not growing in real terms, anything like sufficient to be able to actually stand still. You're going backwards there. And the prognosis is, unless something fundamentally changes, we're going to see more and more of the same thing, which then takes you into the question, well, so maybe the whole financial system is bust. And if it is bust, what are the alternatives? Which of course then takes us into the the crypto discussion and all those sorts of things. And it's not surprising that some people are looking for alternatives, because the financial system isn't fit for purpose, not for ordinary people at the moment.
Yeah, absolutely. Well, guys, if you want all the latest data, all the links to follow Martin's social media and videos are down below. And if you do want some of that crypto research you're doing, head over to the links for our socials down there as well. But great episode. Appreciate the slides. I hope everyone's enjoying these. Seem to be getting more and more packed with things to discuss lately, Martin, which has been great. So hit that like button, subscribe if you haven't already, share these videos around, and we'll talk again soon. Cheers.
Cheers.